In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. Right now, there's a lot of volatilities coming out of the financial market, and we gotta stay on top of which stocks to buy, which stocks to sell, and which stocks to watch on your watch list. In this video, I'm gonna cover the recent price action momentums of Paysafe and the technicals of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $2.85 before closing the trading day at $2.84. We should pay attention to the $3.02 level nearby because it was tested 2 times before, which is a significant level to watch out for. And over the past 30 days, the trending of the stock has been initially ranging between $3 and $4, but recently a very sudden and aggressive downward pressure occurred, pushing the stock to much lower levels, going below the region that we thought was going to provide strong support. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been bearish because the stock price of Paysafe has been declining ever since it went public, despite having a business model that has been up and running for a long period of time with a large following online. I think that the downward trend has been slowing as the $3 and $4 level provided a support that were a lot more solid for a fairly long period of time. But with that being said, the selling pressure on Paysafe remains very significant as we can witness, and I would be careful with buying in now. The trading volume of Paysafe has recently been 9.5 million shares versus the average volume of 6.5 million shares. Over the previous 52-week period, its price fluctuated between $2.83 and $17.25. The market cap of Paysafe is currently at $2.1 billion versus the enterprise value of $6.5 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. At the end of the day, it remains an estimation of the market every time it publishes its financial statements. Therefore, it's less reactive than the market cap, which is refreshed every single day. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they have is called goodwill. Goodwill is the expectation of the market that a company can generate more profit or to have more growth than other companies of the same kind, partially because it may have a better management team, a stronger brand recognition, and a bigger following online. It's basically what is unique about a company in particular versus alternative competitors. In other words, it may not be a tangible asset to generate income, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value and because the enterprise value is less reactive to the market cap in very volatile situations. If the company goes to liquidation, the goodwill would be completely gone, and shareholders and bondholders would be distributing amongst each other what's left on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 1% higher than the 1-month low, 1% higher than the 3-month low, and 1% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility is 117% versus the historical volatility of 66%. The put-call volume ratio is currently 0.27. It's normal for most stocks to tend to have a higher put option than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 7.2 thousand contracts in a day, compared to the 30-day average of 5.5 thousand. In terms of open interest, the most recent volume has been 168,000 contracts compared to the 30-day average of 177,000 contracts. Regarding the shareholder structure, institutional shareholders currently own about 40% of the total float. The biggest ones include Blackstone, Fidelity, and State Street. It's relevant to understand the shareholder composition of a company because it can help us to determine whether you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This obviously is subject to a lot of exceptions since many great companies are also held by retail traders, not the institutional ones. But for the time being, that's the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes when there's significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what has been going on with Ethereum, GameStop, and AMC. The current short interest is very low, between 3 to 10% of the total float, and more than 50% of it come from the dark pool transactions. Overall, my opinion on Paysafe is to keep it on your watch list because the company does have potentials from a fundamental perspective. However, the current sector-wide news is not very attractive for the company and for other growth stocks, and I think that the stock would go through more corrections that are deeper than what they are now before the momentum is regained once again. The maximum exposure I would recommend is between 1 to 3% of your portfolio. And for the immediate term, my recommendation is to wait for better timing because we have to see some confirmations that the support levels have been reached and will be supported before going further. I would recommend to separate the allocation in batches of 25% at a time so you can have enough room for purchases later. Your investment should also take into consideration the market conditions at the time and the surrounding sentiment that determine what kind of asset should be picked, for how much and for how long, and when you should be selling it. First of all, the financial market doesn't reflect the real economy. That much is a fact. If the stock market is doing great, it doesn't mean that the underlying company is necessarily hiring more people, increasing the wages, and rising the living standards of its employees. Sometimes it's even the exact opposite, because the stock market is a big pool where money comes in and out, goes to different places in order to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is been used for non-productive purposes like mergers and acquisitions, paying dividends to shareholders, buying back equity, and so on, the less there is for the productive parts. Another way to put it is that ever since 2008, the Dow Jones Index has increased its value significantly. But people don't necessarily see this growth in the main streets. This is why we should be careful with the assumptions of what rising prices mean for a company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive and that their yields is going down. Additionally, some new phenomena are now palpable, and they are the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullbacks. Bubbles have always been created over and over during the past few centuries, ever since there are financial markets. But nowadays, it's quite interesting to see that the speed at which they are created, attract people or capital, and then go bust is getting faster and faster. So almost immediately after the major collapse of the market prices back in early 2020, the same market decided to create a massive bubble of the electric vehicle sector or anything that is related to it. So almost immediately after the major collapse of the financial market back in 2020, the market then decided to, one, recover any sort of price that fell during the first 3 months of the year, and then attract a massive amount of capital into the EV sector or anything that's related to it. Stock prices across the board, but in the growth stocks in particular, went up to the sky for a moment. And even if it didn't last long, this episode definitely allowed market participants, or many of them, to park in their money in a sector and left with either a lot of profits or at least avoiding incurring large losses because they left their money in blue chips or the sectors that are heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months. Because in the scenarios of a short squeeze, companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then trigger even bigger increase in stock price. But I'm not saying that this is always rational, and I'm not even saying that companies will always have a very convincing narrative or good fundamentals. Sometimes there's none of that. A good example is with GameStop. If you play video games, ask yourself if you would really always buy your games at GameStop, knowing that you would be buying those games online as well, or knowing that at least you have the capacity, the right, to buy those games online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price, for the better or worse. Personally, I think that as long as the volatility is high, it'll create opportunities. The final phenomenon is the anticipation of a recession. Many people are expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because of the debt structure no longer sustainable, or that their business model is just bad. But somehow that system was able to hold its ground, especially in the North American market. This is partially because the capital around the world chooses to come to American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that the capital can provide steady returns without being affected too much by central bank policies and inflations, this phenomenon will intensify over time. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain low because the real economy cannot just improve because the asset prices go up. As far as we're concerned, that means that the patience of market participants over the next couple of years will be a great virtue, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and your risk level under check. Your speculative positions should play a relatively modest part of your overall portfolio, so thanks for watching. If you like my content, please like, comment, and subscribe to my channel.